This region around the Great Lakes has been called the heartland. When it comes to agriculture, there's hardly an area in the world that compares.
Everybody, just hold on. I don't know what we're going to have here.
There's a lot of self-proclaimed geniuses out there that know the national yield, but they're all wrong.
Manage money, piling in.
Double digits higher.
So at this point, we're in kind of uncharted territory.
There's a lot of money on the sidelines.
So that was a crazy one.
That's what brings the viewers back. That a boy.
Good morning, everybody. It's Wednesday, February 11th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you get any questions or comments, please feel free to drop us a line in the chat area. I'll be sure to get to it during the show. Overnight markets are at March corn down 1.5 pennies at 4.27 1/4. March soybeans are down 2.5 at 11.20, and March Chicago wheat was up 1.75 pennies at 5.30. No export sales announcements here this morning. We did get the jobs report out this morning. Came back much better than expected. An increase of 130,000 jobs in January. The estimates were looking for a number closer to 55,000. So stock market ended up rallying on that news. We're up 235 in the Dow right now, 50,508. Unemployment rate ticked down just a little bit, 4.3%. That's down from 4.4% last month. We are now through 7 of 19 settlements for our spring crop insurance discovery period. Corn is currently averaging 4.58. That's up 1 penny from yesterday's settlement. And beans are up 10 at 10.91, and that's up 3 cents from the previous settlement as well there. So beans continue to uptick for our average, which is good to see. Report yesterday, guys, pretty much a non-event. Not a whole lot of moving and shaking there, which was to be expected. I think the highlight was the 180 for Brazil on the soybean side, which I think most people at this point had been trading or were resigned to the fact that it was going to be large. And we'll move all of our eyes now to the next back half of crop insurance, setting the back half of the price. And then we'll get into March and argue about planning. So, Dustin, maybe share a few thoughts here this morning as we start the day, and then we'll throw around the room.
Yeah, thanks, Dan. Yeah, let's start with the relationship of new crop beans versus new crop corn. So this is just the Nov 26 beans divided by December 26 corn as a ratio, and the ratio is moving higher. As you can see, we're within range of taking out that ratio high. We did take out the ratio high for old crop March contracts yesterday, and we're at 2.42 to 1, which it's elevated, but it's not what it could be, right? A lot of times pre-planting, when you think of a really strong ratio, you'd think like 2.55 or 2.6 to 1. We've seen as high as 2.67 to 1 pre-planting. 2.42 to 1 is elevated, and obviously like Trump's recent comments about more Chinese business, new highs in the new crop crush margins, all of that's playing a part into helping that bean price kind of lead the charge there. And I think this is important because what does that mean for corn? I mean, if corn has good demand and beans are starting to give some hope for the acres to switch back to beans comfortably. And we also have, we have such a high rotation of corn last year that going into this year, I don't think that we're as likely to see that try to be retained a bunch of corn on corn acres. I think we could easily lose corn acres if this ratio grows. Switching over to what the problem with corn is old crop corn is oversupplied. At least that's what we perceive it to be, based on the stocks report. So this is a lot of kind of noise on the chart, but basically what we're looking at in black is we're tying that spread low from that Jan report. We're back to 30 under for March to December. And the lower that spread goes, the more signs that we have too much supply, right? That's the whole job of the market with spreads is to try to tell growers we don't need these bushels now. We need them at a later date. Right, because we are going to run into too much supply. Everyone in the East that's looking at strong basis right now is maybe scratching their head saying, why is that? We're seeing strong basis, high demand for corn. But it does still come down to total bushels that are going onto paper contracts, especially in the West, and then the need to sell that paper contract. So this is where the blue line matters. Blue line is showing that flat prices is hanging in there better than the spreads are. And I think that that's what I would say is a real possibility is when we say we're worried about oversupply of old crop corn, it doesn't mean that flat price has to go down. It may just mean that like these signs of abundance, like wider spreads could occur. So all of these are very related. I think the higher that the beans go, the wider the corn spread could get. And like, so what does that mean for decision making? Is what we've been saying for a while. Old crop corn, we think, may have more risk than new crop. There's very little protection left on that. We've already know the bridge payments. We're long past crop insurance, discovery and expiration for last year. The marketing year average is largely established. So it's not like a dollar drop in old crop corn would result in a dollar increase in payments on PLC. We've already established probably at least half of it, maybe 60% of it by now. So when we see people holding on to both old crop and new crop risk and they want to tackle both at the same time, I would just point to where is the balance. If you don't have any protections remaining for your old crop corn and you have crop insurance now being established for new crop, you've got farm bill still long ways away from being established. There are protections against new crop prices. And that's the contract that we think needs to convince acres to hold for corn. There are very few protections left for old crop, and that's something that's important to know for decision making.
Yeah, Nick tends to agree. It seems like old crop corn is going to be a self-fulfilling prophecy as it drags on.
Yeah, we keep having. I mean, I think I've talked about this in this, but the last 3 years running, the low of that September contract came in the August right before first notice day. So you go all the way through the 23 marketing year, 24, 25. All of those happen to be a low in August. Especially the 23 marketing year, August 2024. We call it harvest in August because there's so many contracts that needed to be sold and so many bushels that were being drug out of the bin at the same time. Even though we've been running somewhat tight carryouts, like as far as the WASD is showing, we're still getting the September contract almost near full carry to December. So what does that say? It says that as a nation, we're holding on to corn too long, right? It's taking too long to get the corn moved and sold. And the longer it's drug out, the more risk that comes with that bushel. Now, may not be the case this year. I mean, we could run right into a South American drought in April, May, right? Bail us all out on price. We could run into a drought this summer and bail us out on price. So I don't know that I would say always bank on that, but that's the risk, right? The risk is that we hold it too long and then we're competing with a bunch of other bushels that want to get pulled out of the bin at the same time.
Yeah, Justin, we've talked about it a number of times, and it's going to heat up this conversation of the notion of corn buying acres. And, one of our listeners here this morning, asks about buying acres February, March, and you've talked about it a couple of times with beans doing what they're doing. Do you still feel that way, that there's a potential, or where do beans have to go, I guess, for corn to take notice, in your opinion?
Well, I think it's already starting to some degree, to Dustin's earlier point. I mean, like 235 to 237 on the ratio is kind of long-term average. So you're 242, I would typically say to get a big switch, you're upper 25s to 26. So if you were to do something like that, especially with such a large number of corn acres this year, then I think you get corn really nervous for new crop. Right now it feels like we're, carryouts are big enough as of now. Now, how do things develop with, does China actually buy another 8 million tons, even if it's uneconomically? That just forces a higher premium on beans. So I think it's important to note that this ratio is on the verge of breaking out to the upside, because then I think that's where March corn, for example, and December corn, so old crop and new crop corn, could trade like two separate markets. And if you look at, just to add to what Dustin's saying, the March D's contract, which is the one that he was showing, is at 30 cents. Yeah, remember full storage, not even including interest rates, is 8 cents a month. So even if it doesn't do it all at once, but by rolling from March to May to July to Sep to Dece, could be as high as 72 cents or more. So that's just like the silent part of like slowly losing money and not realizing it while you're just holding a physical commodity, is that you are in essence fighting that uphill battle with carry costs. So that's why we tend to see these things, really white out on first notice day as these things are rolled. So yeah, long story to that answer, but if you looked at, Dustin's talked to us a lot too, if you look at the Brazilian real and November 26 bean charts, they're almost identical for the past 18 months. They might be uncorrelated for a day or two, but not much longer than that. They look very similar. So I do think that's it's definitely helping. And Brazil, I think their economy, their stock market's off to one of the best starts in decades, if I'm not mistaken. I think it's one of the favorite picks of a lot of these money managers this year. So there is, it does feel like they're kind of heating up down there. So I would expect the real to probably stay strong.
Yeah, they're looking for they're looking for like a 25 to 50 point basis cut on their interest rate. They're at 15%, but with how it's been going, they're now starting to talk about a cutting program as well over there. So be interesting to see.
Yep.
Dustin, something to add?
Oh yeah, I just like that they've largely politicized that as well, right? So this latest financial regime is Lula's, which they're bogged down with lots of debt. That was part of the reason why they had such a big sell-off in their currency in 2024. It was worst major, performing currency of all the majors, and it's down like 22%. So I think, we have recency bias of weak markets in part because we've had we've been so undercut by that move that just 1 year of stability, I think, changes quite a bit. And it's actually been rising, to Justin's point. It's part of the reason why I think we can comfortably see the bean rises that we've had in recent months, is that like we're going to become more competitive. But that was the entire concern of 2024 with them, is that they were going to be way too loose on this, despite their debt, and the market, I think, was accurate in it. That literally voted into a much more fiscally conservative approach on the rates. They actually continue to raise rates, the first part of 2025. So if they get into a big cutting phase, that's probably a risk for us. That's what I'm getting at, right? If they overdo it, then we may resume what the market was originally fearing in 2024. So kind of keep a watch out for that.
Mm-hmm.
Well, you've talked about this too, guys, where we've talked about this a number of times, in one of our followers here made mention of the fact that, like, how is the Brazilian farmer doing with a 15% interest rate? And I guess I don't really know what their cost structures are. I'm guessing that they're not quite what we are.
I think, and I saw something, maybe it was a month ago, might not even been that long ago, but just the number of bankruptcies has really shot up in Brazil. So I do think that, to Justin's earlier point, when the currency goes down every year, right, and you buy a lot of your inputs, you're buying it here, and then you're deflating your currency more by the time you're selling your product, that you're actually making that arbitration kind of, or that arb. So when it goes the opposite way and you're paying for your inputs and then your currency strengthens before you have to sell your product, it has a reverse effect. So I actually think that they're getting hurt quite a bit as well. And then at the news of, like, for them, the worst would be that, China has to artificially buy more beans from us, even though, there's arbitrage that'll happen. Rest of the world will, buy South American and all that happens, but that happens at, you have to get to those levels of premiums or discounts, if you will, to get that to move. So they could be getting hit from a couple different sides this way, similar to what we had the opposite happening for the past few years.
And they've had phenomenal weather, so that helps a lot, right? They have 2 growing seasons. They've got a lot of advantages there. So like you get into a bad second season crop or something, that would probably be where the impact starts to hit. But yeah, I mean, imagine you're buying your, let's say it's 5-to-1 ratio on the real. You're buying your inputs, you're importing in dollars 5-to-1, and then you're selling your output 6-to-1. Even if our prices do not change, they're immediately making a 20% return in their own currency. So they have a lot of leeway when you keep getting 5-to-1, 6-to-1, 7-to-1. But if you start off the year at 6-to-1 and go back to 5-to-1, you need a 20% price increase in an unchanged market just to break even. So I think there's going to be a much more reluctance of easy flow when we get into just a normal size crop. Right now I think you're talking 90 bushel yields for a lot of those large farms down there. That's going to flow pretty easily, probably. So,
very good. Quickly, let's move over to livestock. Right, pretty quiet session, all things considered, for cattle yesterday, and it was interesting to look this morning. You're about $4 off the highs for hogs, which, I mean, the way these things are ripping is pretty crazy. So, why don't you give us a little insight here this morning?
Yeah, no, absolutely. The cattle market's definitely holding up, I think, better than most would have expected, just given some of the headlines over the past couple days. We've heard about the opening of the Edenboro, Texas sterile fly facility along the southern border. So obviously this is going to be a larger factor as we move forward. It's a 300 million fly per week program. So it just kind of, I think, solidifies the expectation that the border is going to get open sooner rather than later. And obviously we know the administration is really giving the full court press on this. So that's something I think that there's kind of a big risk as we get into the spring and the summer time frame. And I think the market's just been a little bit cautious since then. Plus you got the Argentinian beef imports likely going to start ramping up here in the next few weeks. So I just think you've had a lot in the news. We've kind of fallen back down to the 20-day moving average, and we really haven't seen any cash trade. So beef prices have also been weaker. Choice is down 21 cents yesterday, and select down 2.45. So we're still searching for that seasonal bottom here in beef, and we're starting off at just an insanely high level. Maybe it's high right now. We'll find out, I guess, down the road. But I think there's just a lot of cautious trade right now in the meats overall. WASI report didn't really, I think, change too much perspective right now. I think just the focus is still kind of on the near term, but overall it just seemed like kind of raised annual beef production by 185 million pounds. So, I mean, at least production is starting to creep up here to some degree. And on the hog side, yeah, it's been kind of straight down for 3 days. You're kind of off the highs right now. I feel like, we just put the cart before the horse a little bit too much here. I mean, cash market has been firm, and now we're starting to see the roll from April to June really start to kind of manifest here. Open interest was up another 1,500 contracts. So it feels like you're just kind of in the midst of that right now. Bellies were down $1.05. And at this point, we're just like in the beef market, we should be kind of searching for that more seasonal bottom activity on the carcass and the cutout. So just feels like with the technical move, April closing below the 20-day moving average kind of leaves room for a little bit more downside. Wouldn't be surprised to see that today on the hog side.
Very good. Appreciate the update. I did just get notice too. We had a late sales announcement here this morning, 230,560 metric tons of corn delivered to unknown for 25. So that was a little bit late posting there, but that did happen here this morning. So we got that announced. We just came into the open. March corn down 1.5 at 427.5. March soybeans are down 3.5 at 11.19, and March Chicago wheat's up 5.25 at 533.5. Tomorrow morning we will have weekly export sales. Those will be out at 7:30 Central. So we'll take a look at those and visit about that in the War Room tomorrow morning. Also in the comment section, you'll notice 2 links for the War Room report. Be sure to check that out. It's got premium content, certainly our reactions to USDA reports, discussions on crop insurance, a lot of good information that can help you this season. Also on a daily basis, you'll receive updates on the markets, headline news, kind of a deeper dive into everything we talk about every day on the War Room. So be sure to check that out. Also, 10% of those subscriptions do directly go to support the AgYield NextGen Foundation, supporting the next generation of ag leaders through our national scholarship competition. So be sure to check that out. It's really cool. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like and certainly subscribe. We will we'll be doing this every day that the markets are open on X, Facebook Live, and YouTube Live at 8:15 Central Time. Appreciate the thoughts and comments here this morning, guys. It was a good show. Hope everybody has a great day, and we'll talk to you again tomorrow.
The War Room is presented by AgYield, a risk management partner of American grain farmers for over 50 years. Looking for more in-depth analysis? Check out the War Room Report. Our team's knowledge and expertise delivered straight to your inbox every weekday. Each report delivers key market-moving headlines, critical weather updates, USDA report breakdowns, and exclusive video content. All for $50 a month. And most importantly, 10% of every subscription will go directly to support the AgYield NextGen Foundation, a nonprofit investing in agricultural education and the future of farming. To sign up for the War Room Report, check out the link in the description or learn more at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.